is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The Saudi National Bank chairman resigns after comments to Bloomberg this month on Credit Suisse pushed the lender's shares into a tailspin. Deutsche Bank shares pull higher, rebounding from Friday's sell-off. Banks lead gains across European shares. Plus, mass protests in Israel. Prime Minister Benjamin Netanyahu is expected to speak in the Israeli parliament any moment now after his controversial judicial reforms sparked more demonstrations. Now, let's take a look at the markets. Quite a lot going on, especially after we heard from Neil Kashkari over the weekend. Now, European stocks, you can see, holding on to gains of 0.6% higher. Really, a lot of the focus is on banks. S&P futures pretty much flat now. We are not as high as we were just about 20 minutes ago. Again, you could see a pretty bumpy week, actually. Later in the week, we follow developments in the banking sector very, very closely. Also, we have multiple Federal Reserve officials speaking. A key measure of U.S. inflation is due. And then, of course, geopolitical tensions with Russia stationing some tactical nuclear weapons in Belarus. The U.S. two-year yield 3.62. For the moment, we're seeing gains across the board. The DAX 0.5% higher with Deutsche Bank stabilizing. We're also getting some IFO figures. So I think we're getting that now. If we don't have them now, we'll get them to you very, very shortly. But this will be a good indication of the stability of the financial sector, of course, in Germany. So let's see if we have that IFO Business Confidence Index 93.3. It's actually stronger than expected. We were expecting a 91 figure, and it's coming in at 93.3. Now, the chairman of the Saudi National Bank, Ammar al-Qudari, has resigned. It follows his comments on Credit Suisse earlier this month, which triggered the Swiss lender's stocks to plunge to its lowest level on record. Now, joining us now is Bloomberg's Youssef Gama Eldin, who conducted that interview. Youssef, was he always going to go after that interview?
I mean, yeah, it was almost inevitable in many ways because the Saudis made a big bet on Credit Suisse in late October, early November. They bought a 9.9% stake, and he in many ways personified that big bet, and he has defended it vigorously to the very end. Here's what he had to say, and here's what triggered all of this.
Absolutely not, for many reasons. I'll cite the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
So refusing to inject any additional liquidity, he tried to walk that statement back in other networks later on. But bear in mind that Saudi National Bank investors are responding to this change in leadership positively. The stock is up a little bit over 1.5%. The role of the Public Investment Fund, which holds about a 37% stake in Saudi National Bank, should not be undermined. And as much as this was a valuation bet on Credit Suisse, it was meant to create synergies. It was meant to put Saudi National Bank on the global map. That's been set back now, and clearly some executive reshuffle is meant to reset credibility and maybe some of those aspirations. Fran.
Youssef, thank you so much. Youssef Gama Eldin there with the very latest on Mr. Al-Qudari. Now, Credit Suisse faces a threat of a possible probe and disciplinary action over how top managers ran the bank in the lead up to its collapse and takeover by UBS. That's according to Switzerland's banking regulator FINMA, reported by Swiss paper NZZ am Sonntag. Now, let's bring in Bloomberg's JP Barnett. JP, what does this mean for Credit Suisse?
Well, I'm not so sure if it means a lot now that the bank is part of UBS and in the merger. But still, while you're pulling off this mega merger in terms of operations that they have to align, you don't want to have like any side stories of regulatory investigations into that issue. What is also interesting to me is like it showed us how skeptical the regulator was of the management for a couple of months now, actually. And that explains a little bit why there was such a haste in merging Credit Suisse with UBS, because the story sends the feel over that the regulator was pretty unhappy with how the bank has been run for quite a while now.
So, JP, what's happening at Deutsche Bank?
Well, I want to be cautious with Deutsche Bank. We see a rebound today. The move on Friday was brutal, but a little bit irrational or extreme, maybe, as some analysts are pointing out. What we're seeing overall in the European banking sector right now is a repositioning of earnings expectations. And of course, some banks that have a higher exposure to corporate lending, and then especially Deutsche Bank with a high exposure to Germany as the biggest economy in Europe, are getting hit a little bit harder. But I think, like, so far, we have not seen any evidence of instability or liquidity concerns within the European banking system. But what the market is doing, and he's right so to do so, is repricing its earnings expectations for banks going forward.
So, JP, stateside, First Citizens Bank is buying SVB this morning. What do we know there?
Well, that's a good sign here. I'm not sure if it's like the end of the full story for the U.S. banking system, but at least we have like one pending problem solved here. And overall, I think we can take the conclusion that everything was dealt with rather quickly, which is a good thing. The regulator did not hesitate or wait too long for any systemic contagion spread too far. Is it totally over? We will see how deposits will keep on developing forward in the U.S., and that will certainly remain in focus of investors for the coming days and weeks.
Great. JP, thank you so much. Jan Patrick Barnett there with the very latest on the bank. So Silicon Valley Bank has been sold to First Citizens Bank with all its deposits and loans taken over. That's after the San Francisco-based lender was seized by regulators after a run on the bank. Now, that impacted deposits for small banks across the United States. Joining us now is Bloomberg's Valerie Teitel with the very latest. So, Valerie, good morning. What's the latest from the Fed's deposit data?
Yes, the Fed deposit data we got after the close on Friday didn't paint a pretty picture, Francine. It showed that small U.S. banks lost 2% of their overall deposit base. It was the biggest outflow these banks have suffered on record. But there has been some more positive developments recently that show that this might be the worst, and perhaps the worst is past us. One of that being that the emergency lending that the Fed does, the bulk of it still stayed in the New York and San Francisco Fed districts, implying that it hasn't spread to other banks in other regions, smaller Midwest banks, for example. And Fed members continue to reiterate that they see deposit outflows as stabilizing. We heard this directly from Powell in his press conference, from Fed Bostic on Friday, and from Neel Kashkari over the weekend, painting maybe a more positive picture that the worst is behind us when it comes to these deposit outflows.
Valerie, thank you so much. Valerie Teitel there with the very latest on deposits. Now, coming up, recession fears rise. The Fed's Neel Kashkari says the recent banking turmoil brings the U.S. closer to a downturn. We have plenty more on that next, and this is Bloomberg.
What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. And then that credit crunch, you're right, just as you said, would then slow down the economy. This is something we are monitoring very, very closely.
Well, that was Minneapolis Fed President Neel Kashkari. Let's stay on the recession risk story. Joining us now is Daniel McCormack, head of research at Macquarie Group, and Bloomberg's Christina Kino. So thank you both for joining us. Daniel, how worried are you that there's an impending recession that actually, stems from a pretty big credit crunch in the U.S.?
Yeah, I think, and thanks for having me, Francine. The banks were already tightening credit standards before this banking crisis hit. That's true in the US, and it's also true in Europe. And I think it's definitely true that one certain consequence of this little banking crisis that we're going through right now is that banks are going to tighten credit conditions further. And that's going to exacerbate what is already fairly weak economies and fairly sluggish momentum. So I think it will accelerate what is already a sort of slow-moving downturn.
So where do you see the best opportunities, Daniel?
Well, within listed equities, I mean, we would be quite defensive at the moment, given that I think we are on the cusp of a slowdown, both in Europe and in the US. So I'd be looking for companies that are defensive, that have low leverage, both operating and financial, that have the ability to control their margins, that have exposure to genuine structural growth drivers rather than cyclical growth. These would be the types of exposures that we would be looking for.
Christine, when you look at dollar dynamics and the fact that actually we could see a weaker dollar from here, how does that change everything?
Well, Francine, I think it really is reflective of how investors are thinking about this, right? It is really a question of, do they want to be in U.S. dollar assets or not, given the current environment? And I think the real driver of that is really what's happening in the bond market and the rate market dynamics that we're seeing at the moment. Because at the moment, we are seeing those rate cut expectations getting built into that curve, even as soon as later this year. The Fed was very clear that that's not their base case, but investors just aren't listening at the moment. And that's really not something that makes the dollar appealing at this point in time.
Yeah, and so Daniel, what does it mean? I mean, what's the case actually for staying fully invested given liquidity concerns and given the panic one we saw in the banks?
Well, I think it's just how you position at the moment. I mean, I think, as I said, you should be positioned defensively within the listed equity space. I mean, I think bonds look pretty good at the moment, particularly at the short end of the curve. I think expectations around central bank activity are really peaking out now. So, you know, we would have a defensive positioning overall.
In terms of what we're expecting, of course, it's inflation in the U.S. I mean, do we ditch the dot plot and just assume that central banks are done, Christine?
Well, Francine, I think it's far from conclusive at this point in time because it's difficult to discount what policymakers have really been telling us time and time again. And we have seen their ability to kind of pivot back and forth depending on what the data is telling them. I mean, we saw that over the last couple of weeks where clearly inflation worries take precedence over banking sector worries for the Fed, the Bank of England, and the ECB. And while they do very clearly have this kind of peripheral vision, whether the banking crisis kind of spreads more widely, I think it is still very clear that inflation is very much the priority. And so expect more of that tension to moving forward, that banking versus price stability versus financial stability, very much still the question over the next couple of policy meetings.
Daniel, what's your take? I mean, are they done? Is the Fed done? Could we really see the market is pricing in cuts? Is that a real possibility?
Yeah, I think there's a really interesting divergence between what the Fed is saying and what the market is saying at the moment. Those divergences open up periodically. I think the Fed is done, and I think the ECB and the Bank of England are done as well for now. But I think one of the really interesting things that's going on at the moment is you're seeing a real divergence in the inflation performance between the US on the one hand and Europe and the UK on the other. We got the UK inflation figures out last week. Much more sticky than what was expected and much more sticky than what we've seen in the US. And overall, I think this is not a huge surprise because if you think about the UK and European economies, they just have much more mechanisms to keep inflation stickier for longer. So there's much more wage indexation, unions have more power, there's more regulation which limits the scopes for markets to do their thing, reallocate resources and bring prices down. So I think this is something that all three of those central banks are going to be battling with right now. And it's really going to be tricky for the ECB and the Bank of England going forward.
But so, Daniel, give me a sense, where are we in the cycle? And if we've never seen this before, is it a 70% chance of a policy mistake?
So we're right at the point in the cycle where central banks pause and markets start to push them towards cutting. And the question, I think, from here is, what happens, obviously, with the banking sector, what happens with inflation and what happens with growth. But we are, I think, in a structurally different kind of environment than what we've been in for 30 years. And what we may see, where people may be surprised and markets may be surprised, is inflation doesn't come down as rapidly as it normally would when growth falls away. That makes policy decisions very, very tricky. It makes investing very, very tricky. And I think, you're really going to see that play out, particularly, as I said, with the Bank of England and ECB, because I think inflation in both of those countries/regions is likely to be much more sticky than it is in the US.
And Christina, then they have to manage liquidity.
Absolutely, Francine. And again, this really makes for a tough balancing act for central banks because it brings us back again to that question of, do they prioritize financial stability in the form of providing liquidity to markets and reassuring investors that this is not the banking crisis of 2008, or do they keep at inflation? Because again, as Daniel pointed out, in the UK especially, that's still very much a problem, despite the fact that we've seen a lot of rate hikes already from the Bank of England. But yeah, I think it really is quite the optionality problem at the moment. We've seen some calls for them to perhaps maybe lay off the forward guidance and emphasize their data dependence and development dependence instead.
Thank you both for joining us. Daniel McCormack, head of research at Macquarie Bank, stays with us, and Bloomberg's Christina Aquino. Now, coming up, nickel trading on the London Metal Exchange resumed Asian hours trading today. We'll bring you the very latest on how the expanded trading hours are going. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance early edition. of Francine Lacqua here in London. Now, the London Metal Exchange has resumed Asian hours trading of nickel contracts, marking a crucial step in efforts to repair the market. The metal opened for business at 1 a.m. UK time, more than a year after the LME suspended trading and cancelled billions of dollars of deals in response to a massive short squeeze. Well, joining us now for more on this is our London Metals reporter, Mark Burton. Mark, so why has this taken so long, and how's trading so far?
It has taken a long time for them to take this step, which was very much intended to be a temporary measure because of ongoing concerns about the risk of very sharp price moves during Asian trading hours when trading in all metals is not particularly liquid. They were planning to reopen it a week ago, but delayed that because, as they stated, there were concerns that there might be sharp price moves in the wake of this discovery that some of the metal that was in their warehousing system was actually bags of rock rather than bags of nickel.
I know, that story's incredible. I know, couldn't get enough of that story.
It never ends for the LME.
How does that even happen?
I know.
So when are we expecting trading volume to go back to normal?
Well, it's the key question. There are lots of doubts about whether it can really return to the kind of liquid market that it was prior to this crisis. There's still a lot of investors out there who are angry at the LME because of these rather unprecedented steps that they took to try to rein in the short squeeze last time. The progress so far would suggest that it's going to take some time, if at all. Trading was incredibly illiquid this morning, and it's really only picked up now that Europe has opened.
Mark, thank you so much. Mark Burton there, Bloomberg's metals reporter, joining us on the LME. Now, still with us, Daniel McCormack, head of research at Macquarie Bank. When you look, Daniel, at the UK economy, and we touched a little bit about the Bank of England, I'm looking forward to a lecture, actually, from Andrew Bailey a little bit later on, which I'll attend. I mean, does he have a harder job almost than anyone? Because inflation is not even sticky. It just keeps on rising when economists are expecting it to fall.
He has a very difficult job, Francine. I really wouldn't want to be in his shoes at all. I mean, as you rightly say, inflation is still in the double digits. It went up last week, despite the fact that it's been coming down pretty much everywhere for 6 months or so now. And at the same time, he has an economy which is crawling, right? The UK has basically been in recession since the middle of last year. So despite no growth, inflation is not coming down, proving very sticky at high levels. And this just makes the decision for the Bank of England, very, very challenging, because you cannot afford to have inflation expectations get embedded into price setting and wage behaviour. But on the other hand, of course, he doesn't want to over-tighten. He doesn't want to tighten monetary policy into what is perhaps, a mini banking crisis or certainly a tightening in credit conditions from the banks.
Yeah, so on the banking crisis, what is the underlying reason that we had? I know it's a loss of confidence. There was, I don't know whether it's idiosyncratic to some of the names that we saw go under, or whether you think this could spread elsewhere in the Eurozone, but also in the UK.
I think it's a very uncertain environment. What I would say, Francine, is that I think for the banks that have experienced trouble so far, there seem to be some bank-specific or idiosyncratic factors that have influenced that. That is clear. Now, whether it spreads more broadly than that is very difficult to say. But one of the things I'm certainly watching for is asset write-downs. I think there are a number of spaces out there in the economy that are vulnerable. So particularly commercial property, the office space is challenged at the moment. There could be some private equity companies that experience difficulties over the next 6, 12, 18 months. And so banks with concentrated exposure to that could see some write-downs and potentially could see some challenges. Now, that said, I would say the global banking system is in much better shape than it was pre-GFC. And that is particularly true for the European banks, which from a capital and liquidity perspective are in much better shape than their US counterparts, and of course much better shape than they were pre-GFC or at the time of the sovereign crisis.
So, Daniel, I don't know whether after the kind of uncertainties about inflation and Brexit, the UK could be a bigger investment opportunity than the rest of Europe.
Well, I mean, the UK still has some work to do, I would say, to turn investor sentiment around. I mean, we've seen a number of companies out there pause on their investment plans for the UK, but things slowly seem to be getting sorted out from a Brexit point of view. I mean, I think the real challenge is this one we mentioned earlier, this macroeconomic challenge whereby the Bank of England really has to thread this line between getting inflation under control, which is absolutely crucial for medium-term growth, but not over-tightening right now. Now, if it can get that right, the UK will return to growth. It's a dynamic, open economy, but they've got to get that right.
Daniel, thank you so much, as always, for joining us. Daniel McCormack, Head of Research at Macquarie Group. Coming up, banks still in focus this morning, both here in Europe and stateside. We'll check the markets and discuss the fallout from this month's turmoil with Jackie Bowie from Chatham Financial. That's coming up next, and this is Bloomberg. The Saudi National Bank chairman resigns after comments to Bloomberg this month on Credit Suisse pushed the lender's shares into a tailspin. Deutsche Bank shares pull higher, rebounding from Friday's sell-off. Banks lead gains across European shares. Plus, mass protests in Israel. Prime Minister Benjamin Netanyahu expected to speak in the Israeli parliament any moment now after his controversial judicial reforms sparked more demonstrations. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first thing is first. After the huge pressure we saw on European stocks on Friday, let's check in on European banks and what they're doing in today's trading session. Now, we have a board up for you, and this is a picture across the board. So Deutsche Bank gaining 4%, not quite recouping some of the losses that they had on Friday, but still an upside. BNP Paribas gaining 1.5%. Now, traders in for another bumpy week. Developments in the banking sector, of course, very closely watched. We'll also get onto U.S. regional banks shortly. On top of that, we have a lot of Federal Reserve officials speaking. Key measure of U.S. inflation due. There are also renewed geopolitical tensions with Russia to station tactical nuclear weapons in Belarus. Now, this is a picture across the board for some of the U.S. regional banks that are just starting to open pre-market. The concern there is that as we saw liquidity dry up or credit crunch, then this could actually bring the U.S. recession closer. You can see First Republic gaining 18% pre-market, PacWest Bancorp also gaining 8%. Now, joining us to discuss all of this, Jackie Bowie, Managing Director at Chatham Financial. Jackie, great to have you on the program. Thank you so much for coming in. When you look at the banks, have we found a floor? Is there a bit more stabilization, or could anything happen?
Yeah, I think it looks like a little bit of a short-term relief rally. I mean, the sell-off on Friday was pretty bad. I would say that there's still a lot of fear and lack of confidence across the sector. So still a bumpy road ahead.
But why? So if you look at exactly what happened on Friday, and I know it was fear, it was, I guess, contagion. There was nothing really that one single thing that sparked it off. And there's, a lot of jokes around, well, would you put your money in that bank? But this was a safe bank. So again, what can you intimate from what happened on Friday to what could happen to other European banks?
Yeah, I mean, generally people are very focused on counterparty credit risk, and you could have said the same thing about Credit Suisse 2 days before the merger happened with UBS. Deutsche Bank's had its troubles, a few years ago, and if we look at the price of insuring against a default in Deutsche Bank, so those CDS spreads, that's what the market looks at to give an indication as to what other banks might be in trouble.
Yeah. So could the market seize up again? I mean, fear. The problem with fear is that, once you have fear, it's very difficult to get hold of it.
It's very difficult for it to disappear, other than central banks globally have made a very concerted and joint effort to make decisions together around providing liquidity to banks in order to try and stave off those fears that there is a bigger banking crisis happening.
So, Jackie, do you worry about a credit crunch?
Yeah, and I think that is already underway. Even if we have no more banking failures, global interest rates rising, one major lender now removed from the market, and banks are reining in credit. So all of those factors together means we're moving into a credit crunch.
Credit crunch, what, in the UK or
I would say in the US. I would say in the
one.
US and across Europe.
So can we avoid a recession in the US?
Yeah, I think a month ago we probably would have said yes. Same in the UK. The economic data was showing signs of slight positivity. I think with the situation in the financial markets, I think that is now a bigger question.
Yeah, and of course it points to the fact that central banks now have to make the decision, do they go for financial stability or do they take inflation, to where it needs to be? What's the lesser of two evils?
Well, if we look at the decisions made by the Fed last week and the Bank of England, what they told us is that inflation remains their focus. But behind the scenes, as I say, putting in place huge amounts of extra liquidity to support the banking sector.
But does that mean that actually, and we heard, we saw a wobble last week when Janet Yellen was short of guaranteeing all deposits. Are we going to see just much more credit lines and regulators step in with financing credit and central banks supporting all the banks?
Yeah, and that's what they've done already. I mean, the swap lines coming from the Fed are now on a daily basis, the same as we had during the financial crisis. The Fed looking to provide liquidity based on collateral that's Treasury yields at par, so not applying a haircut or a discount to that. I mean, that provides banks with a huge liquidity line, so they shouldn't have to draw in credit as much as they might have done before. And
then investors worry about moral hazard.
Yeah, I mean, that's a bigger behavioural point. And I think that really came out of the US support for SVB, where all deposits were guaranteed. It feels like European regulators don't want to go that far for that reason.
All right, thank you so much for joining us, Jackie Bowie there, Managing Director at Chatham Financial. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Israel's Prime Minister Benjamin Netanyahu is reported to be considering a delay to his Supreme Court overhaul plan after a night of demonstrations. Local media say key ministers and aides have been urging a pause in the controversial policy. This after the Prime Minister fired his defence chief over a dramatic speech criticising the plans. Now, Ammar al-Qaderi, the chairman of Saudi National Bank, has resigned. Credit Suisse shares slumped to a record low after al-Qaderi told Bloomberg he would not support the Swiss lender any further. The Saudi National Bank was the biggest shareholder in Credit Suisse. In the aftermath, UBS agreed to buy its Swiss rival in a historic government-brokered rescue aimed at stemming a loss of confidence. Now, Ukraine is calling for an extraordinary meeting of the UN Security Council to counter what it calls a provocative plan by Russia to station nuclear weapons in Belarus. Russian President Vladimir Putin has defended the move, saying the US has long kept nuclear weapons in the territory of its European allies. The chairman of the UK's Office for Budget Responsibility says leaving the European Union had an impact on the British economy similar to the coronavirus pandemic. Richard Hughes told the BBC that Brexit will cut long-run output by 4%. He says growth has also been held back by declining productivity, a shrinking workforce and also stagnant investment. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans and this is Bloomberg. Francine.
Leanne, thank you so much. Now, the latest polling in France shows that President Emmanuel Macron has lost voters to the far right over pension reform. Protests have rocked the country, with Le Pen's national rally gaining 5 points in one poll. Bloomberg's Caroline Conan has the latest from Paris.
From this to this. Clashes between protesters and the police have become a regular scene of Parisian life, with beans burning and tear gas reminding of the student revolution of May 1968. Even in the southwest city of Bordeaux, the gate of City Hall was set on fire. Meanwhile, the garbage has accumulated in the French capital. It's a very different image from the dynamic, modern France promoted by Emmanuel Macron when he was first elected in 2017. The 45-year-old former banker wants to raise the minimum retirement age from 62 to 64. Most French are opposed to this, giving Macron two major problems. Problem number one, critics say he's touching the very heart of the French way of life and social model. Problem number two, his method. Lacking a parliamentary majority, the government used a decree to force the reform through without a vote. That has angered millions of French people. Macron's popularity has fallen to the lowest in 4 years. Protests by the so-called yellow vests against fuel taxes blighted his first term. Now the deep opposition to his pension overhaul could threaten the remaining 4 years of his reform agenda and leave the door open for the National Rally candidate Marine Le Pen.
Bloomberg's Caroline Conan in Paris there. Coming up, Trump in Texas. The former president ramps up his attacks on federal officials investigating him while appearing at a campaign rally. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Donald Trump has railed against the investigations that he faces while appearing at a campaign rally in Texas on Saturday. A New York grand jury is considering charges against the former president in relation to hush money payments he made to a porn star before his 2016 election. Now, joining us with the very latest on U.S. politics, Morris Reed, partner at Actum. He was also an advisor in the Clinton administration. Morris, as always, thank you so much for making us smarter on U.S. politics. So first of all, will Trump run?
Absolutely, he'll run. There's no reason for him not to run. Even if he's indicted, he can still run for president.
Really?
Absolutely.
What would make him not run? Or what needs to happen for him not to be able to run?
Nothing. Donald Trump will run for president. The question is, will he get through the primary? If there are 4 or 5 people in the primary, I think he gets through, which makes the Democrats happy. If it's Democrats or any Democrat versus Donald Trump, it's a Democrat, lean Democrat for sure.
Okay, so who's running? We have Nikki Haley. We have DeSantis. We have Trump. Anyone else that could actually get it?
I think that you might have Pompeo, Pence may also run. I think there'll end up being 5 or 6 Republicans to run.
Who do the Democrats want to try and beat? Who's the easiest win?
The easiest for the Democrat is Trump. I think that anyone running against Trump is lean Democrat. Anyone non-Trump running against the Democrats is probably a toss-up at this point.
Who's going to be the Democratic candidate?
Right now it's going to be Joe Biden, but you never know. I also like the governor of California's odds. I like the governor of North Carolina, for example. People don't talk about him enough. I like him a lot.
The governor of California is not too left-wing?
I think he is. He's probably too left.
Yeah.
But when you are a governor of a major state, you have the ability to galvanize voters and raise money. You can't really count him out if there's going to be an open primary.
Morris, and I know we're a couple of years away, but the economy's going south, right? Inflation is also partly because of, the big packages that Washington pushed through under President Biden. Does that work against him?
It works for him in some cases, works against him in others. For example, I don't believe that we have a banking crisis in America. I think we have a regional banking crisis. There's an international banking crisis, but the Wall Street banks seem to be solid. I think that the president wants to make sure that there's not a lot of unemployment right now. So the stimulus package, he needs to get the money to the street. The only way to really push back on this is that when people are shovel ready and people can get to work. So he needs to make sure people are working, because as inflation goes, there will be a lot more layoffs.
But a banking crisis, even if it's contained, plays into the Republicans' hands, even if it doesn't impact the big ones.
Not necessarily, because if you look at what the Democrats are saying, they're saying they want more capital requirements. Republicans saying they want less capital. So if you're a Democrat, you can really play this. You're saying we want safety and soundness, where the Republicans want to be laissez-faire and give the bankers whatever they want. So it's how you play it ultimately.
But inflation, inflation's a headache, right?
Inflation's a headache for everyone.
Any president going into a cycle, especially when you have a Fed that probably has to crush the economy to get inflation under control.
Yeah, it's interesting that, this is where you really see separation of powers in America, where the Fed will have to do what the Fed has to do.
Yeah.
But the president certainly doesn't want to see a lot of unemployment going into a re-election campaign. So it'll be interesting ultimately to see what happens. I tell you one thing that's really interesting. There was a lot of chatter last year about Yellen leaving and there being a cabinet reshuffle. There will be no cabinet reshuffle at this point. There's no way that Yellen can leave at this point in time.
Okay, why not? I mean, cabinet reshuffle just because she's too important or because it's a bad look?
No, it's because of the economy. She wanted to leave. You thought that the Commerce Secretary would move over. Terry McAuliffe may go to Commerce. But because Yellen is a household name and you have a mini crisis, you need to have someone that the capital markets really understand and appreciate her ability.
Are we underestimating the vice president? Could she not actually run and have a fair shot at it?
I think it would be very difficult for her to run at this point. I think she's better sticking on the ticket. But ultimately, if it's an open primary, I think you'll see these two governors who can raise a lot of money come to the forefront.
Okay, on foreign policy, and this is like your specialty, looking at what U.S. politicians can or can't do. I mean, do they need to continue bashing China on both sides of the aisle to attract voters?
Well, it's interesting. There's two things happening in Washington that's very interesting right now. The speaker and the minority leader are actually getting along.
What? Stop the press.
Exactly. I was just hosted the minority leader last week in New York, and I was like shocked. So that's one thing that's working. And bashing China works for both sides. It's not going to stop. The next 18 months is going to be very, very difficult for anyone dealing with China. You saw the TikTok CEO, he was hammered. He did a terrible job. And anyone coming forward on the Chinese side, I think it's just going to be very difficult for them at this point.
But is this one thing that they say in public and then go through back channels to make sure that they still have a relationship with China? I mean, the biggest economy in the world and the second cannot not get along in this kind of
I think that
environment.
It works for both sides, right? It works for the Chinese government to say that they're standing up and being strong to America. But it certainly works for American politicians to say that we're going to push back on China. But also, there are real issues on the supply chain. There's real diversification needed. That's why you see things like the African Growth and Opportunity Act getting a lot more play because it helps push back on China globally. So it's real, but America has to do more than lip service. They've got to put money to work. They've got to put actions to work if they really want to push back.
How long can the U.S. keep on supporting Ukraine with weapons and money?
Forever.
Even if it's a Republican president?
Forever. I think that this is an existential crisis for the West. And it's very interesting that next year you'll have the U.S. presidency up, UK prime minister up, and the European election. So there will be a stress test for Western democracy next year. So I think that they're going to have to steadfast.
But what happened? I mean, I don't know what are the chances of Trump being president, but you hear a lot of Vladimir Putin just biding his time to wait for that to happen because he'll have an easier time going forward.
I don't see it happening, but there's a lot of chatter about that. There's also lots of chatter of Donald Trump's people saying that if he was president, he wouldn't have gone in. One really never knows what would happen, but certainly I think it'll be difficult for any president, even Donald Trump, to walk away from NATO and their allies on this situation.
But Morris, the U.S. needs China on Ukraine. So if you keep on bashing China, it complicates the matter significantly.
Well, there's always, you can speak with forked tongue.
Okay.
China and America needs each other. That's the fact of the matter. They need to get to the table and figure out a way to work together. But we have to understand, when economies are rising, that means ultimately someone's falling. And when someone's falling, they're worried. The American population is worried. The American government is worried. China is on the rise, and they really, really need to come up with concrete solutions. Rhetoric does not work when you're dealing with China. You have to have concrete solution that engages China, but also you have to have solutions that really put your money to work. Just for example, in Africa, the Africans are saying, America, we hear you, but the Chinese are putting up capital. So if you really want to play ball, put that $500 billion to work. Let's make Nigeria a construction site for America on the gas.
First of all, will they? And also, there's a lot of questions from senior diplomats in Europe then saying, the U.S. has taken care of their allies less. So what's an incentive, for example, for African countries to get them in more?
No, it's interesting. If you look at Africa, you look at Asia. These are two very different things. If you look at Asia, there's been a compact for Asia for a long time. Asian countries are worried. That's why you see the military build up. People are spending more money. Japan, for example, is spending money on this. So they're really worried. Will America stand fast if they're needed? From an Africa context, it's not such necessarily a military thing. It's economic empowerment. The Africans are going to stand with whoever's going to empower them economically.
Morris, I find it incredible to see a very divided U.S. What's the way forward for this country to be less divided, frankly, on all issues?
The way forward is more people like the speaker and the minority leader to actually work together, right? Find areas to agree on. And when you disagree, you can disagree without being disagreeable. So it needs leadership. This is one of the big things I talk about. There's a lack of leadership around the world. This is an opportunity for the Speaker McCarthy and Hakeem Jeffries, who are young men. They're both under 50, are going to be around a while to work together. So it's really the way America moves forward is the politicians, the leaders need to show the example and turn down the rhetoric.
Morris, thank you so much, as always, for your talk, of course, on U.S. politics. Morris Reed, partner at Actum, former advisor in the Clinton administration. Now, coming up, protests over judicial reform, flights curbed, and the sacking of the defense minister. We'll bring you the very latest from Israel as Prime Minister Netanyahu mulls his next steps. That's next, and this is Bloomberg. Media reports in Israel claim Prime Minister Benjamin Netanyahu is considering a delay to his judicial overhaul plan. Now, this comes after Israel's main trade union launched a strike affecting departures from the international airport and follows a night of heavy demonstrations. Joining us now is our Israel Bureau Chief, Ethan Broner. Ethan, so what exactly is the latest on the ground?
The latest on the ground is that there is an enormous struggle for the heart and mind of Bibi Netanyahu at the moment. There's a general strike, a kind of almost a nuclear option, bringing down, stopping the economy, preventing flights from going out, ending treatments, except emergency ones in hospitals, law places, and as well as the universities. On the other hand, those who are on his right and his supporters are vowing that they're going to get out in the streets and show these guys what a real demonstration looks like if he does halt the delays. So at the moment, we don't know what's going to happen.
So, Ethan, where does Netanyahu, Israel, and the security apparatus go from here?
We don't know. I mean, obviously, if he decides to call for a halt, that could lead to a breakup of his own government from the right, or it could also lead those who are supporters on his right to go back out into the streets and protest as well. So it's very unclear where we're headed right now.
Ethan, is the only way to actually slow down if Netanyahu is going to save Israel's democracy?
It's the only way to slow down. The only way to slow down this legislative proceeding is for him to say we're not going forward with it right now. There's a whole bunch of steps involved, but one of the key ones is on the floor right now, and it has to do with how judges are selected. If judges are selected principally by politicians, that many feel will lend the legal system to become kind of enslaved to the political system. People are very upset about that.
Ethan, thank you so much. Ethan Broner there in Tel Aviv with the very latest, so we'll see what happens, of course, going forward. Now, let's also look at European banks. If you look at what the stock price in Europe is doing, early gains for U.S. equity futures seem to have evaporated. If you look at European equities, they're still gaining, but not as much as before. Traders in for another possible bumpy week. Developments in the banking sector will be very closely watched. On top of that, we have many Federal Reserve officials talking, and then a key measure of U.S. inflation is due. You look at the European banks, Deutsche Bank gaining 3.2%. Bloomberg Surveillance Early Edition continues in the next hour.
Look, I think we've done a pretty damn good job. People's savings are secure. The banks are in pretty good shape.
The Federal Reserve has to be much more vigilant in constraining excessive risk-taking in the near term. And yes, it has to continue fighting inflation.
They can do that within their existing authorities simply by being clear they are prepared to use systemic risk exemptions.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. The chairman of Credit Suisse's largest shareholder, the Saudi National Bank, has resigned. His comments helped spark a slump in the Swiss bank's shares. There's a buyer for Silicon Valley Bank. First Citizens has agreed to purchase the deposits and loans of the bank, whose collapse rocked the financial system. And in Israel, thousands protest against Prime Minister Netanyahu's plan to curb the power of the Supreme Court. Netanyahu fired his defense minister for criticising his proposals. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And at the end of this week, Matt, we get to focus on those normal things like inflation numbers out from the US and from parts of Europe as well. But right now, we're still dealing with the aftermath of what we've seen in the banking sector over recent weeks.
Yeah, it's amazing. I mean, we continue to get new news on banking. Now we've got the SVB takeover. We've also got news that First Republic will continue to be supported by the government, though they have yet to find out or to announce at least how they're going to do that. Let's take a look at how this is affecting markets. First off, here in the U.S., S&P futures are gaining, and they have been throughout the morning up by about 1/3 to 0.5%. However, for a brief period around 4 a.m., S&P futures and NASDAQ futures dropped below the zero level. So they were negative for a moment. This volatility that we've seen over the past few weeks, it's definitely here to stay, at least for another week. So keep in mind that even though we see gains right now, this could change. U.S. 10-year yields rising about 4 basis points right now to 341.72. So we're at a relatively low level here compared to the highs, but also much higher than we were during the crisis, the heart of the crisis, if we can call it that. The Bloomberg U.S. Dollar Index also feeling relatively safe, right? If this is a safe haven, if this is where people go when they're freaked out, they're not very freaked out right now at 1236. Last year, we were at a high of 1356, and over the course of the last few weeks, we've risen up above 1250. Now we're back down, and you're starting to see gains in other currencies. Most interestingly for me, the euro, as the ECB remains kind of the final hawk, and I'm sure we'll see the euro quote soon. NYMEX crude down below $78. It is up 28 cents in the session, but right now it's 69.54, and we see Brent around 75 as well. So relatively low levels in crude, even as oil traders are forecasting gains. We'll keep an eye on the oil sector here, but for the most part, commodities have taken a hit along with the rest of risk assets. Take a look at what's going on in Asia. We have a big drop in Hong Kong. I'll get to that in a second, but the MSCI Asia Pacific down about 0.5%, so not so bad there. The Hang Seng had recovered to some extent, but then losses in Meituan shares as well as Tencent shares taking about 150 points off of the index. So even though Meituan had solid earnings for the fourth quarter, they beat estimates at least. Some analysts are out saying that the margin forecast is weak, and as a result, they're cutting price targets. So that's hitting the Hang Seng hard. The Nikkei closed up 1/3%. So a different story in terms of what's going on in Japan, and the dollar gaining a little bit of strength against the yen as well, right now at 131.13. So now, Anna, let's see what you've got going on in Europe.
Yeah, we are seeing a little bit of a rebound from those losses that we saw on Friday. Remember, Friday's session, Matt, was really deeply negative here in Europe. Most of the continental European markets were down by more than 1.5%. The banking sector was very much at the heart of that. Today, we see a rebound. We see a rebound in banks, and we see a rebound in broader stock sentiment. So European equity markets are up by just shy of 1% in France, by just more than 1% over in Germany. Let's have a look at some of the components that make this up. And we are seeing that rebound in the banking sector, up by 0.6%, not making up for all of the losses of Friday by any stretch, but certainly a little bit of a rebound. And that's true of Deutsche Bank. This has been really volatile. Matt, to your point earlier on, we've seen a lot of volatility here. Down 8% during Friday's session, up 5% straight out of the gates this morning, then paired those gains to be up just 1% earlier on, now up around 3%. A lot of uncertainty around this business on Friday, but I know that Citi analysts, for example, saying that the selling of Deutsche Bank on Friday was really irrational, and lots of commentators over the weekend struggling to find any kind of real serious explanation as to why we saw such weak weakness in that particular share price. Novartis, here's a nice good news story. This one up more than 6% as a result of the Swiss business announcing the results of a breast cancer trial. The trial of this particular drug showing some really interesting and positive results. And as a result, the Novartis share price goes higher. I didn't put the euro in here, Matt, but I did put the German 2-year yield because we had the iPhone numbers out from Germany a little bit earlier on. And I wanted to just remind myself to mention those. Actually, the German 2-year yield moving in keeping with what we're seeing in the US and in other parts of Europe. So we're seeing those yields go a little bit higher in this morning's session. But the IFO data was interesting. It showed that the expectations amongst German businesses were actually on the rise. That was a bit of a surprise. And the IFO Institute themselves suggesting this is because of the underlying recovery story in the German economy after that terrible winter and expectations for a terrible winter, rather than the volatility that we've seen in some of the big banking names over recent days.
All right, well, we do see the euro right now trading at 107.68, so climbing a little bit against the U.S. dollar, and I'm sure we'll touch on that with Van Rom a little bit later on. Right now, let's get back to the banking story. The chairman of the Saudi National Bank has resigned just a couple of weeks after his comments to Bloomberg's Youssef Gamal Al-Din on Credit Suisse pushed the Swiss lender's shares into a tailspin and eventually forced the consolidation, the sale of the bank to UBS. Youssef joins us now from Dubai. So, Youssef, what stood out to you in this announcement after, I mean, not only wrecking Credit Suisse essentially with one statement, but also hurting his own investment in that bank?
Absolutely, Matt. The big bet on Credit Suisse cost the Saudis about, well, in excess of $1 billion now that you're counting the chips. The thing to bear in mind is that the resignation in itself is not necessarily a surprise. Over the last couple of days, some of my sources suggested that the final strings were being pulled. But this man in many ways personified that big, bold gamble on the Credit Suisse stake. And here's what he said on that day about the bank.
Absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator, and we're not inclined to get into a new regulatory regime.
So an unequivocal comment there that sent the share price tanking. At the same time, you consider that the Public Investment Fund, so Saudi Arabia's sovereign wealth fund, has a 37% stake in Saudi National Bank. So you can imagine some of the discussions in the background. This was always meant to help Saudi National Bank get on the global platform, compete with other global lenders, and this is now a setback. Anna?
Yeah, so that phrase, absolutely not. That'll go down in financial history, won't it? How significant is the news then of this management change at Saudi National Bank? It's the largest lender in the kingdom. Is it specifically linked to your interview and your interviewee there, or is it a broader story?
Yeah, it's a bit of a broader story. So Saudi National Bank has actually taken the Credit Suisse news in relative stride, and it has outperformed some of its peers, both within Saudi Arabia and within the region. You take a look at how the stock price is performing as we speak, up about 1.5%. The Credit Suisse exposure was under 2% of the firm's market capitalization. Bloomberg Intelligence has done some fantastic work, and they think that the hit is about 50 basis points on the CET1 ratio. But taken together, now that Saudi National Bank is resetting credibility and trying to push forward perhaps with a bit of a new tone, this is all getting reflected in the actual pricing, and we'll see how it all evolves over the coming days, guys.
All right, Youssef, thanks so much for joining us. Bloomberg's Youssef Gamal Al-Din talking to us about the resignation of the head of the Saudi National Bank. Now, Credit Suisse is facing itself a possible probe and disciplinary action after it's been sold over how top managers ran the bank in the lead up to its collapse. Switzerland's banking regulator told a local newspaper that the bank had a cultural problem that translated into a lack of accountability. Really? Tom Metcalf, Bloomberg finance reporter, joins us now for more. So, Tom, this all seems very obvious, right? We saw it result in essentially the collapse of the bank, which has now been sold to UBS. How will it even happen?
Yeah, I mean, look, it's very much behind the news. And look, my sense of this is really the Swiss regulator speaking to, the Swiss population, getting polls out that suggest a lot of ordinary Swiss people are pretty annoyed by the government intervention, the fact that, UBS has been jammed together with Credit Suisse. And to me, this looks like sort of them trying to shift the blame and just bring in all the sort of scandal, et cetera, at Credit Suisse back into focus.
And moving to the US banking story, Tom, good morning, where we also have some news flow. Just coming in the early hours of the European morning, in fact, we heard that First Citizens, confirmation of that Bloomberg story, that First Citizens is going to buy Silicon Valley Bank. And the CEO of First Citizens suggesting this should add comfort, add confidence around the US banking system. Is that how this is going to be interpreted, do we think?
No, it should. This is kind of one of the big shoes to drop. This is what people were waiting for, to get a bit more clarity around, this regional banking uncertainty. So, yeah, no, coming over the weekend, and it looks so far, if you look at the futures, they're all largely up. As you'd expect, this is injecting a little bit more reassurance into the market, so I'm seeing a lot of green today.
So, but just, Tom, essentially, the Credit Suisse story really revolves around what happens to the domestic unit, doesn't it?
Yeah, I think that's what most people in Switzerland banking certainly are most focused on. And, the sense is UBS are doing everything they can to keep it. I think the interesting thing there is obviously it brings up the idea of, concentration in the market. UBS was obviously big in Switzerland already. And that, there's sort of going to be a bit more kind of pushback against that at some point. Doesn't look like so far, but that I would agree is sort of, A, it's the crown jewel of Credit Suisse, and B, it's kind of what everyone in Switzerland is focused on.
Well, they either need more competition or they're going to get a lot more foreign bankers involved in domestic corporate finance. Tom, thanks so much for joining us. Bloomberg's Tom Metcalf there covering some of the banks for us. Back stateside, the turmoil from SVB's collapse has impacted deposits for small banks across the U.S. Joining us now is Bloomberg Markets reporter Valerie Teitel. So, Valerie, what's the latest from the Fed's deposit data?
Yeah, we got this data on Friday after the close. It's the first print from that Fed's data that shows the extent of the deposit flight during the week of Silicon Valley Bank's collapse. Now, small banks in the U.S., this data revealed, lost 2% of their deposit base in those days around that collapse. Now, we have to remember that this is the main worry facing the U.S. Banking system going forward, that losing these deposits will possibly make these smaller regional banks pull back on their lending activity, perhaps tighten credit standards, and lead to somewhat of a mild credit crunch when it comes to bank lending to the main street. Now, in just 1 week, they lost $120 billion worth of assets. The market is going to be very, very on top of this release on Friday, and if it shows that the extent of the deposit flight has continued.
Yes, because it comes with a little bit of a lag, doesn't it, Valerie? So we'll again focus on that data when we get it weekly this Friday. On other news, in terms of the U.S. narrative, Minneapolis Fed President Neil Kashkari has been warning that recent bank turmoil has increased the risk of a U.S. recession. He spoke on CBS's Face the Nation over the weekend.
What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. And then that credit crunch, you're right, just as you said, would then slow down the economy. This is something we are monitoring very, very closely.
There's that credit crunch phrase again. Minneapolis Fed President Neil Kashkari speaking there just yesterday. What is his view? I mean, that's his view on where the credit story, I suppose, goes. But what about his view on deposit flight? Did we get any insight there?
He was a bit more positive about it, echoing the similar comments we heard from Powell and from Bostic on Friday, saying that the deposit outflows seem to have slowed down. Now, I think the positivity around these comments we heard from him yesterday is allowing the two-year yield to rise overnight, as we maybe think that the regional bank worries will quickly be over and we'll be back to thinking about how high and how quickly the Fed's going to hike rates into restrictive territory. Now, the pessimists would say these regional bank worries are not going to abate until the Fed cuts rates. They have a hard time competing with money markets to keep these deposits, and their business model isn't as profitable when the front end of the yield curve is this inverted. So the pessimists out there really think that this regional bank woe will continue until the Fed cuts.
All right, Valerie, thanks very much. Bloomberg's Valerie Teitel talking to us about the Fed reaction to the banking issues that we've seen and what I guess bankers really want the Fed to do. Whether they're listening or not is another question. Let's take a look at some of the stocks that we're watching in U.S. pre-market trading. First off, Berkshire Grey, which is an automation company, a robotics company, actually founded by the guy who was the chief technology officer at iRobot. It's not related to Berkshire Hathaway. It's just out of Bedford, Mass. Up to date, 19% in the pre-market after news it'll be acquired, or the remaining shares that aren't owned by SoftBank will be acquired at a 24% premium to Friday's closing price, and that's why you see the big pop here. Then First Republic, and really take a look at a number of other regional banks, Key West, PNC, PacWest, all rallying today following a Bloomberg report that U.S. authorities are considering more support in some way. We don't know yet in what way for banks. Of course, First Republic itself has been thrown a lifeline by some of the biggest banks on Wall Street, and also there is a new Fed facility from which they can borrow. It doesn't look like there's the kind of run risk that we saw at SVB. But as I said, you can see other banks rising on this report as well. For example, PacWest is up 7.5%. I think KeyCorp was up about 5% in the pre-market as well, Anna. So you're seeing these banks doing fairly well today. And, you know, we finished Friday on a positive note. We finished last week on a positive note, and we're kicking off today on in the same regard.
Yeah, Europe just catching up a little bit with that. So up by 0.9% on the stock 600 as we certainly closed in the red for Friday's session. We will talk about the bank sector, what we've heard over the weekend, what it all means. Roukaya Ibrahim joins us, BCA Research Daily Insight Strategist. We'll also talk about the tightening cycle stateside. If we do see a quote-unquote credit crunch, what does that do in terms of financial conditions? How much of the Fed's job does that do? We will also talk about protest activity in France, also in Israel. Protests escalate overnight in Israel. We'll be live in Tel Aviv with the latest on Prime Minister Netanyahu's plan to reduce the power of the Supreme Court and the pushback he is seeing to that plan. Plus, Jack Ma's self-exile, how the business leader's time away from China may be undercutting the country's push for private business. More on today's big tech story ahead. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I've got a chart here in front of me. For those of you listening on radio, you can't see it, but you can certainly feel it. It's about volatility among three different asset classes, equities, FX, and bonds. Now, in March of 2020, we saw these indicators all spike up to the same level. Obviously, we were freaked out by the shutdown of global economies and the rampaging virus of COVID-19 that calmed throughout the pandemic. And then we started to see a breakaway of FX and bond market, especially volatility from equity volatility in 2022. Now, it looks like judging from the VIX, there isn't much volatility in equities. A lot of people will tell you the VIX is broken. But if you look at the MOVE index, which shows us bond market volatility, it's at a high that we haven't seen since March of 2020, indeed higher than it was then. Joining us to talk about why is Ven Rom, Bloomberg Markets Live editor. So, Ven, what's going on here with the MOVE index? Why is bond market volatility now at a level that's frankly scarier than it was at the beginning of the pandemic?
Absolutely, Matt. I mean, if you were Rip Van Winkle from the fairy tales coming out of hibernation and wondering what's going on, if you looked at those VIX volatility, you would conclude everything is hunky-dory with the world. We know, of course, that there is nothing hunky-dory about the world macroeconomic backdrop at the moment. So what's going on is the presence of zero-day to expiry options eclipsing and usurping the place of what used to be the VIX domain. Now, if you look at VIX options, they're typically it captures the maturity of options from 23 to 37 days. So you're talking about an average of 30 days. Whereas with zero-day expiry options, obviously, as the name suggests, there is no theta decay. And therefore, investors are thinking, why would we pay for volatility that we don't perhaps need it? Especially if you're going to position for, say, the non-farm payrolls data, you want to just pay for that particular event, calendar risk event. And therefore, zero-day to expiry options have become more popular and taken the place of VIX, and therefore we see what we see.
That's really interesting. So the market finding other ways to express its nervousness around that volatility story. So you take us to early 19th century US literature when you reference the volatility there. Take us to an aviation metaphor for what you see for the US economy then, Van, because we spend a lot of time talking about hard landings and soft landings, but there are alternatives.
Evidently, there are alternatives, which I think is probably a go-around. Now, the economy was coming in for evidently a soft landing, if you believe Powell and co. But looks like the events of the past 1, 2, 3 weeks, starting with the Silicon Valley Bank failure, suggest that, you know, this is an economy that may touch down pretty soon, probably doing it now, and then take off again if everything works out well for the financial industry.
OK, we'll keep an eye on that then, Ben. Thank you very much, Ben Ram of the Bloomberg Markets Live team with his thoughts on the US economy and much beyond. For more market analysis, check out the Markets Live blog. MLIV Go is the function on the Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Coming up on the programme, we'll speak to Roukaya Ibrahim, BCA Research Daily Insights strategist. What is the shelf life of a banking crisis? How far through the banking crisis are we? Lots to focus on when it comes to banks, but also inflation later on this week. We'll have a conversation with Roukaya next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The chairman of Credit Suisse's largest shareholder, the Saudi National Bank, has resigned. His comments helped spark a slump in the Swiss bank's shares. There's a buyer for Silicon Valley Bank. First Citizens has agreed to purchase the deposits and loans of the bank, whose collapse rocked the financial system. And in Israel, protests, thousands protest against Prime Minister Netanyahu's plans to curb the power of the Supreme Court. Netanyahu fired his defense minister for criticizing the proposal. I'm Anna Edwards in London with Matt Miller in New York. And coming early in the European hours, Matt, we got that news around SVB's assets. Finally, US authorities finding a buyer, a home for those, designed to give some comfort, I suppose, to investors and to risk assets. And US equity futures trying hard to stay in positive territory.
Yeah, absolutely. And of course, Bloomberg also came out with a report, Bloomberg News, saying that the Fed and other authorities are continuing to consider ways to help banks that are in crisis mode. So that's really helped futures. I mean, to be fair, we closed up on Friday, and the close was a positive for the week. We were even positive the week before that. So 3 out of the last 4 weeks, we've been up. The problem is that one of those weeks we were down 4.5%. So S&P futures are up again to kick off the week. Expect some volatility because we've seen volatility in the futures already, right? Around 3 a.m., futures started to come down from 0.5% up and eventually went into negative territory before bouncing back to the almost 1/3% gain that you see before you right now. We do see investors letting go of the perceived safety of government debt. So that's another good news. Another piece of good news. Now, U.S. 10-year yields are up about 6 basis points at 343, 344. And the Bloomberg U.S. dollar index is also down right now, only 1/100%. Nonetheless, this signifies that investors aren't looking for safe havens like the greenback. NYMEX crude is up a little bit, 32 cents a barrel, but still holding under $70. So on the one hand, that signifies this lower level for crude that investors are still not terribly optimistic about the economic prospects in the future. On the other hand, it makes it easier for businesses, factories to operate, at least cheaper for them to operate, and you'd hope that also translates into lower prices at the gas pump. Take a look at some of the movers in the market. Berkshire Grey, not related to Berkshire Hathaway, but a really interesting company which makes robots for factory automation. It was founded by the guy who is the chief technical officer for iRobot, maker of the Roomba. It's up 21 cents. Anna, do you have a Roomba yet? I know there was talk about you getting one. First Republic Bank also gaining on that Bloomberg News report that the Fed and other regulators are looking at ways to continue to support this bank, and on optimism that it's not at levels near a run that we saw driving SVB out of business. And that's bringing other banks up as well. PacWest is up 8.5% in the pre-market, but you look at KeyCorp and a number of other regional banks also rising just a little bit less. Did you not have a Roomba? Did you never have a Roomba?
No. I remember this conversation. No,
Yeah.
I was unsure what it was, and you kindly explained it to me, Matt. But you know that I don't have a reputation for being the earliest adopter of new technology. Let's just leave it there, shall we? So no, I don't have one. European stocks then up by just shy of 1%. You closed in positive territory, Matt, on Friday. We closed deeply in negative territory. The banking sector led us lower, but we're rebounding from some of that, and keeping our nerve, it seems, a little as we go through the first hours of the European trading day. We've seen a lot of volatility in the Deutsche Bank share price. It was down by 8% in session, down by more than that in session during Friday, but by the close down by 8%. Today it raced out of the gates up by 5%, went down to up 1, now it's up 4. So we do see a little bit of resilience, or a bounce back at least, coming through on Deutsche Bank. I know Citi analysts were saying that it didn't really make any sense, the level of selling that we'd seen. Irrational was the word that they used on Friday. And Novartis is up by 6%, a breast cancer drug coming out of trials with a really positive outcome, and so that's doing well for the Swiss giant of the pharmaceuticals industry. And here's the euro, 107.62. And Matt, I've seen different analysts over the weekend, some from Vanda Research, some from Goldman, talking about their views on the euro and whether it is too highly valued or not at this particular juncture. And a lot seems to come down to whether you think that the ECB is still going to be hiking more than the Fed. It's those interest rate differentials. That's part of the story. In terms of the data flow today, we've had the iPhone numbers out of Germany, and that showed in the expectations number a surprise rebound in expectations around the German economy, despite all of that banking volatility that we saw last week.
All right, so we'll continue to watch. Certainly, I'll continue to watch the euro because I think it's interesting if the ECB is kind of the last hawk standing, what happens to that currency versus the dollar, especially as investors are more sanguine about the banking industry. Let's talk to Roukaya Ibrahim right now, BCA Research Daily Insight Strategist, about that calm in banking right now. Roukaya, we did see what a lot of people referred to as a crisis over the last few weeks, obviously sparked by SVB, but then kind of rounded out by the sale of Credit Suisse, a fire sale to its crosstown rival. We didn't see the TED spread blowout. And when I was a kid, that was what you looked to, the indicator that you looked to signal a crisis or not. What's your take on this, especially as LIBOR is supposed to at some point go away?
Right, that's true. LIBOR is getting phased out, and so you should probably focus on alternative measures. And so some key measures that we're looking at is the difference between the forward rate agreements and the OIS, the overnight interest rate spread, as well as the 3-month repos and the OIS. And both of those measures actually are not yet at levels that were during the initial phases of the COVID pandemic or during the GFC crisis. And so that signifies that, investors, while they are concerned about the banking turmoil that's going on, you call it a crisis, but they're not yet pricing in this broad-based impact on the economy and the banking sector. And we generally tend to agree with that. I think that there are going to be lingering concerns after this gets settled, hopefully in the coming weeks and months. For example, the bank lending standards are going to tighten, and that's going to have an impact on the broader economy. But we don't see this as morphing into a broader crisis. Now, of course, as you mentioned, the buyout of SVB is positive. At the end of the day, this is a confidence of a crisis in confidence among the banks, and so that should put some improvement in the confidence. But, at the end of the day, it's animal spirits, and it's very hard to know where those are going to go. So we'll be watching those spreads carefully.
So, Roukaya, having said that, what do you think about some of these assets? Have they been discounted enough that they're interesting, or, has the market been supporting them well enough throughout what some have called a crisis? Not me, really, but, it was definitely turbulent times. So have the prices taken enough of a hit that you can go in there and do a little bit of bottom feeding?
In the case of financials, no, we don't think that those are attractive yet. At the end of the day, the macroeconomic environment is not positive for financials. As I mentioned, bank lending standards are going to tighten. That's going to lead to a reduction in loans. The economy is darkening, even if it doesn't lead to a crisis in the immediate term, it is signaling that monetary policy is getting tighter. Central banks are still hiking interest rates. And so that's negative over a cyclical environment, a 6 to 12-month environment for the economy. And so that means that, banks are going to continue to underperform, in our opinion. It's not yet a good time to bottom feed.
And so on that subject, good morning to you, Roukaya. On that subject, I mean, are we talking about something that you would call a credit crunch? Is that what we're looking at? And is that going to be the key piece of data that you watch for, along with the things you were discussing there with Matt? Also looking at the credit impulse in the US economy. That's going to be key for central bank policy, of course.
Absolutely. And that's what we heard actually from Chair Powell last week during the Fed press conference, is that, what he's watching for, they're continuing to hike, or they continued to hike interest rates last week. And what they're really watching for in terms of the impact of this banking crisis is the impact on lending and lending standards, and that impact on the broader economy. And I think that that's pretty much what central bankers are watching right now. They still see inflation as being problematically elevated. And so they're not ready yet to pivot to pausing and then easing, maybe. But what they're really watching for is that this banking turmoil translates into something broader for the economy. And then that would cause them probably to adjust their policy.
And we know that war in Europe has had something of an inflationary impact, Roukaya, on the European economy and beyond when we look at what's happened to commodities. Thinking about the impact of war on the financial universe that we talk about, Roukaya, I know that the defense sector is front and center for you. Where do you see the money going, essentially, in that sector?
Absolutely. I think the war in Ukraine really highlights the need for more spending on defense among the Europeans and the NATO. And so actually, what at BCA, we've estimated that there should be an additional $240 billion going to defense spending until the year 2030. And so what that means is that there's going to be this injection of demand into the defense spending sector. And aerospace, European aerospace and defense is one of our favored equity sectors, both within the European equity universe as well as relative to the US. So we think that that sector is going to benefit quite a bit, especially if you take a look at just the broader environment, geopolitical environment. We have a multipolar world. We have Russian instability, going forward, and that should support the sector as well.
Hey, Roukaya, we were talking earlier with Ben Rahm, our currency strategist, about the real bifurcation that we've seen in volatility indicators. I'm not sure if that's the right word to use, but I hear Tom Keene saying it a lot. In any case, we have the VIX showing a whole lot of nothing going on, but the MOVE index is like to the moon right now. More volatility in the bond market than we saw over March of 2020. What do you make of this discrepancy?
Well, I think in equities, if you take a look at what has been helping equities is, that the fact that bond yields have come down so much, and that has supported, for example, certain equity sectors. If you take a look at information technology and communication services, these long duration equity sectors, they have benefited from these lower bond yields. But going forward, I think that, as I mentioned, in this macroeconomic environment over a 6 to 12-month horizon, where even if the banking crisis or the banking turmoil settles down, monetary policy is getting tighter. That's definitely not positive for cyclicals, for equities in general, for risk assets. And I think that, that's going to lead to increased volatility as we move forward.
Roukaya, thank you very much for your time. Roukaya Ibrahim of BCA Research. Coming up on the program, we'll talk about protest activity in many different geographies. Protests escalating overnight in Israel. We'll have the latest on the Prime Minister's plan to reduce the power of the Supreme Court and the pushback he is receiving against those plans. That's what we see in the streets. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Poland's finance minister. That is at 10:30 a.m. New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, French President Emmanuel Macron is facing increasingly violent protests that risk scaring off investors that he has spent the past 6 years courting. Bloomberg's Caroline Conan reports on what's at stake for the country.
From this to this. Clashes between protesters and the police have become a regular scene of Parisian life, with beans burning and tear gas reminding of the student revolution of May 1968. Even in the southwest city of Bordeaux, the gate of City Hall was set on fire. Meanwhile, the garbage has accumulated in the French capital. It's a very different image from the dynamic, modern France promoted by Emmanuel Macron when he was first elected in 2017. The 45-year-old former banker wants to raise the minimum retirement age from 62 to 64. Most French are opposed to this, giving Macron two major problems. Problem number one, critics say he's touching the very heart of the French way of life and social model. Problem number two, his method. Lacking a parliamentary majority, the government used a decree to force the reform through without a vote. That has angered millions of French people. Macron's popularity has fallen to the lowest in 4 years. Protests by the so-called yellow vests against fuel taxes blighted his first term. Now the deep opposition to his pension overhaul could threaten the remaining 4 years of his reform agenda and leave the door open for the National Rally candidate Marine Le Pen.
That was Caroline Conan in Paris talking about the protests there. Now over in Israel, thousands have taken to the streets to protest Benjamin Netanyahu after he fired his defense minister. Joining us now for more is our Israeli bureau chief, Ethan Bronner. So, Ethan, what's the latest on the protests there?
Well, they were very, very vigorous overnight, and then there were water cannons used by cops and so on, and it was cleared away, but the highways were impassable for many hours. And then there was a little bit of a break while we were trying to figure out what happened. Right now, they're coming back out. Tens of thousands of people back out on the street. Some have now shut down the highway near Tel Aviv. Some are gathering near the Parliament building, the Knesset, where everyone is waiting to see what the Prime Minister says. It has been announced that he was due to speak. It's already 2 hours beyond when he was supposed to give his speech in the Knesset, in the Parliament, possibly halting this judicial overhaul.
Yes, I was going to ask, where does Netanyahu go from here? Where does the security apparatus go from here? Because there had been some local reports, I think, in Israel that suggested he was considering at least delaying the changes he wants to make to the judiciary.
I mean, he's obviously been in a very, very difficult position, facing enormous pressure from the business community, from the military, from the trade unions that have shut down much of the economy today, stopped flights going out of Ben Gurion Airport, and the business community that has built this country into one of the wealthiest in the world, which is opposed to these changes. On the other hand, the more populist supporters on his right who are insisting that he must go ahead with curbing the power of the court, because a lot of what the court has done has angered the right. We shall see where he ends up, but the word at the moment is that he's likely to delay rather than to stop the procedure forward of these judicial changes in the Knesset.
All right, Ethan, we'll continue to follow this story with you. Thanks so much for joining us. Bloomberg's Ethan Bronner there in Tel Aviv talking to us about those protests. Now we've got chaos and strikes in Germany as well, or at least you should be prepared for that today. Air and rail services there joined the UK and France by protesting for higher pay. Bloomberg's Oliver Crook joins us from Berlin to give us the latest. Oliver?
Hey, Matt. Yeah, so we have two unions teaming up here. You have the services union Verdi and also the rail transport union EVG. So they started these strikes at midnight tonight. This has been pretty well telegraphed, and it's not the sort of chaos that we're seeing, in Israel and in France, but it is, disrupting all kinds of travel. You have flights that have been grounded. Long-distance regional trains across Germany are closed. And as you'll know, Matt, the S-Bahn and U-Bahn distinction, the U-Bahn is running, the S-Bahn is not. And these are all the sort of train services across Germany that are, that are basically ground to a halt here, and as well as the air travel. But we got a bit of that taste of that chaos yesterday with some issues with Deutsche Lufthansa, and it's all down to wages, right? So the Verdi is demanding a raise of 10.5% of the wages. They're now locked in their third days of talks, and what the what's been offered is about a 5% raise, which is just not cutting it at this point. So, this is all down to the same conversation we're seeing across the world and across Europe. Inflation rising up, and of course, we get inflation from Germany later this week. In February, we had the figure at 9.3%. We're expecting that to come down a little bit, but still 7.4% may not be the kind of reassurance that Germany and the rest of Europe are looking for.
Yes, I suppose that there's a sort of race against time here, isn't there, Ollie, when it comes to the rate at which inflation comes down in Europe and the extent to which protesters want to carry on asking for more money. We've seen some pay deals being done here in the UK. Actually, incidentally, since we got the budget, there have been a flurry of pay deals being done with various unions, sort of outside the spotlight. We wonder where this one goes from here in Germany.
Indeed, and there's not really a sort of a path for this to be completed anytime soon. Again, it said they were asking for 10.5. They're only getting 5% in 2 different installments. There's also this one-time bonus tax-free of 2,500 euros per employee. And again, this is not really moving the dial substantially enough forward. Again, but this has all been sort of flagged. The question is over the Easter vacation. So we have from local German papers that there is not going to be any union strikes for around that. But of course, that would put the real squeeze on travelers across Germany. And if we see this really further escalating, it could become a much larger problem here in Germany. At a time when already we're seeing some issues with the coalition that are sort of emerging, where they're still locked in talks over this weekend trying to solve some of their issues. So again, not welcome here in Germany.
OK, well, at least we see a little bit of calm restored to German banking, up by 4.9% on the Deutsche Bank share price, which would probably be a relief to many in Frankfurt. Oliver, thank you very much. Oliver Crook joining us there from Berlin. Coming up, a look at the market-moving events that we are watching out for this week. That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Let's take a look at what's coming up this week. Later today, German Chancellor Olaf Scholz holds talks with Dutch Prime Minister Mark Rutte. Watch for any comments there on the alliance, NATO, as well as what's going on in Germany. We just heard from Oliver Crook. On Tuesday, the U.S. Senate Banking Committee holds the first of several hearings on the collapse of Silicon Valley Bank and Signature Bank. That's followed by a House hearing on the recent bank failures that comes on Wednesday. We will get U.S. GDP data on Thursday, so that's the start of a lot of economic data coming out. Friday brings euro area inflation. We expect headline inflation to fall sharply in March due to reduced energy costs. Core inflation may rise slightly again. And then after that, we get inflation data out of the U.S. We get the PCE, which is the Fed's preferred measure of inflation. So it'll be interesting to see. I think the PCE headline number is expected year over year at 5.1%, which is still higher than the Fed's highest target rate.
Yes, we'll be looking for that later on in the week, won't we? A return to the inflation conversation. Might that be a relief after all the turmoil that we've seen in the banking sector of late, Matt? And we get the Eurozone inflation print as well. Interesting that we've seen Joachim Nagel, the Bundesbank president, saying that the ECB is determined on inflation with markets in view. So ongoing conversations about the extent to which we'll see tightening. And that seems to be an interesting one that a lot of investors want to talk about, the extent to which the ECB might hike more now, even as inflation seems to be coming off the boil in Europe.
Absolutely, but we heard also from Luis de Guindos, the Spanish banker who is, I believe, second in command at the ECB, and he says they're going to have to go meeting by meeting now, considering the bank turmoil.
Yeah, much more of a focus on the data and meeting by meeting and less focus on providing forward guidance. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.